Let's get a look at what we can expect from the local market in a bit more detail. Bring the experts in. Evan Lucas from IG Market joining us from Melbourne. Evan, we're watching these Syrian fears abate, at least for now. How much of an impact do you expect this to have on the local market?
Yeah, with this Syrian sort of whole idea now sort of taking a bit more of a backseat, we did obviously see the UK Parliament voting against it. The other thing that we're sort of asking the question is, what's the end game that would come with any sort of punitive strike? It would obviously be something from the seas. It's most likely that the US would do something along that idea with a missile strike on some of the compounds in Syria. And let's be honest, the Israelis have been doing that probably for the last sort of 6 or 7 months, and they haven't been able to get any sort of traction with doing that. So it's probably why it has abated. It has seen the oil price really sort of move down a little bit further. But I think what's going on at the moment is, again, it's getting back to taper. We've always suggested that basically this Syrian crisis was a spark to really get the markets a little bit more jumpy, a little bit more volatile, and start to really concentrate on what is going to be probably a very, very interesting 17 days as we do head into September. That meeting on the 18th and 19th of September for us here in Australia is going to really drive the markets all the way through to Christmas. And overnight, there was some more interesting news. We saw Janet Yellen actually presenting and suggesting that she is probably unlikely to get the job as Fed chairman, and that puts more and more likelihood on Lawrence Summers to actually pick that up. There was news reports over the last week and a half that he was being vetted by the White House, that he would actually possibly become the new Fed chairman. And with that in mind, he's actually a little bit more probably hawkish in terms of where the rest of the board sits, and particularly the group of four in Janet Yellen, Ben Bernanke, Bill Dudley and Jamie Bullard, which are slightly dovish. So that's all put that back probably into perspective, and that really is sort of feeding into that idea that we are going to see tapering. There is more and more talk about it being in September, regardless of what we're seeing coming out of the sort of the uneven data. Again, we probably still think that it may actually happen in October. We think the September meeting will be the blueprint meeting, and then tapering to happen in October and November. But it will be very, very interesting. And if it is the case that Janet Yellen, who is probably the most dovish, doesn't get it, then we do go along with Lawrence Summers. It will probably change that rhetoric even more, and we may actually find tapering coming faster rather than sort of on a slower rate than what's currently planned.
It's interesting because the US market did digest, I guess, the increased chance of tapering on the back of that GDP read. Now, given we do have a lot more data to come, including US non-farm payrolls next week. But I guess if we want to focus in on where is really feeling the pain from this taper talk right now, and that is emerging markets, and India now in particular.
Yeah, and that's the interesting part that's coming from that, and it actually really puts the sort of an Australian focus on it very, very closely. India is our 4th largest export partner. It is really a lot of what we do. It is certainly where we are concentrating a lot of our sort of time and effort from a diplomatic point of view, as well as we look to the Asian century sort of moving ahead, and India is well and truly a part of that. We've now seen the rupee. Yesterday it dropped 3.9%. That was the largest decline it's had since 1993, and it got to around about 68.4 rupee to the dollar. Last night it actually went to 69 rupee to the dollar. And what's really concerning with regards to what's happening in India, they import 80% of their oil exports. Now, yes, we did see a drop-off in oil prices last night, but they have a rising current account deficit is getting to the record highs that we've never seen. They've also got unbelievably high inflation, and last night there was talk that the central bank over there may have to step in to try and cool that down. Increasing real rates as well is a real problem for the Indians. They, less money to actually spend on imports and what they do, less money for the household with the rates going up there, and inflation biting in as well. It's an all culmination for a real problem. And if that comes back to an Australian point of view, we send a lot of agricultural products over there. A lot of services products come in and out of the country as well. And that all relates to the whole idea that if emerging markets see what we've seen over the last 5 months, where $8.7 billion US has been recouped out of the country to basically go back into the US, Europe and also Japan, more and more money coming out of the country from foreign investment is also going to slow that economy down. So that is the scary part of emerging markets, and it is unfortunate that most of those emerging markets are here in Asia, and that will be a real sort of interesting development over the next couple of months to a year, particularly from an Australian-centric point of view, as we do export and import a lot of products from these countries.
And particularly from an Australian dollar point of view as well, as global investors often use the Australian dollar as a proxy for Asia, but in a twist that could actually end up being a positive for our economy as well, Evan. I mean, we have the Reserve Bank Board meeting on Tuesday, unlikely to make any move in interest rates for a number of different reasons, but one in particular, obviously, is the falling Aussie dollar, and this whole emerging markets theme will likely put more pressure on the Aussie dollar going forward, don't you think?
Yeah, absolutely. And also, if you're a trader or an investor in currencies out there, you're going to be looking at the Aussie dollar US dollar pair more and more than you're going to look at the US rupee pair or looking at the US Indonesian rupee pair, because the spreads on them are really quite large and it's quite illiquid in the currency terms. Whereas the Aussie dollar play is exactly as you alluded to. It is a play on that sort of pseudo-Asia play, particularly China, but also, yes, places like Indonesia and also India, considering the kind of products that we offer to the world and that part of the world. So that's where you're going to look, and that does put, as you said, that whole easing cycle we've seen from the RBA over the last 7 months probably on the back burner. It will mean that the Aussie dollar could naturally start to actually depreciate on its own by global investors actually getting involved with what's going on in emerging markets. We also saw yesterday the CapEx numbers, although the sort of FY14 numbers were not as strong as some has expected, they were quite good in terms of where they're looking. They are back into sort of expansionary period. The mining sort of fall away hasn't occurred probably as quickly as expected, and Glenn Stevens follows that very, very closely. And with that in mind, it's probably going to see a bit more of a hold on that sort of easing cycle, particularly next week. It's almost definite that he won't cut, and it may even put the November rate cut that everybody's expecting on a little bit more of a sort of a shaky footing. The swaps market is still predicting about 45% chance of a 25 basis point rate cut in November, and if we see more and more data of green shoot idea, that'll get smaller and smaller. So that is the case. The Aussie dollar is definitely that pseudo play to Asia, and that's what we're watching closely because it's an easier play to do with tighter spreads. Okay,
speaking of Asia, Japanese CPI data is due out today. Is that one of the cues we're looking for to the local market throughout the afternoon? I mean, given especially that we've got Labor Day weekend coming in the United States.
Yeah, absolutely. And there's about 4 pieces coming out of Japan today that are going to be. So you've got Tokyo core CPI, you've got country CPI as a whole. You've also got industrial production numbers, and all of this feeds back into what the Japanese have been doing over the last year and a half since Abe took power, particularly with regards to watching that inflation number. He is really, really trying to make sure, and that again gets back to Kuroda, the BOJ governor, of them trying to get to that 2% inflation target inside 24 months. We're now around about 6 months into the program. And one thing that we talked about at the start of the year is the market needs to see that there is progress happening. If there isn't any movement in inflation, there is a real concern that they're not actually going to be able to get it done and move out of that 20 years of deflationary periods that we've seen in Japan. So it's going to be very, very interesting, particularly from the US dollar JPY sort of trade. It's one that everybody's been watching very, very closely, and the yen is a flight to safety. And if there is no sign of inflation happening, you could actually see that dollar moving up, and that will definitely put pressure on the Nikkei. The inverse correlation in there is very, very strong, and if the yen appreciates, you will see the Nikkei off, and that will filter through to the ASX very, very quickly if that is the case today, Nadine.
Okay, Evan, a pleasure speaking with you. We'll check in with you later in the day.
Thanks, Nadine.
Evan Lucas from IG in Melbourne there.